How's it going, everyone? This is Nick from Reventure Consulting, and this is a special video today because I'm going to bring you guys 100 years of housing market data in America, lots of historical context so you can understand just how big a housing bubble America is in right now. I know it's a confusing time for a lot of you. A lot of you are frustrated by the current state of the housing market. A lot of you think this is a bubble that's never going to end. But I'm telling you, when you look at the historical data going back 100 years, that helps really clarify what's going on in today's market, particularly related to the comparison of how much home prices are going up in America to how much income is going up. This is such a key relationship, home prices versus income. And as you're going to see over 100 years, the relationship is very, very strong. And the problem with today's housing market is that the relationship is broken down over the last decade, and home prices have gone up way more than income. And as we'll see historically, that's not a sustainable situation, and it's something that suggests we're in for a big housing crash. And so we're going to just start things off by looking at the year-over-year growth in home prices in America since 1930, over the last 90 years, how much home prices have gone up over the previous 12 months. And you can see here at the end of 2021, we were up 19%. The typical price of a home, according to the Case-Shiller Home Price Index, went up 19% in America from 2020. And then also 2020 had high growth at 10%. And this 2-year window here was one of the highest growth times for the US housing market ever in America. There's only 3 other times in US history that come even close to matching this level of appreciation. The most recent was in the mid-2000s. We had a big housing crash after that boom. Then we have the mid to late 1970s, which was an inflationary period in America. There was no big housing crash after that boom. And then we also have the mid-1940s, right after World War II. There was no housing crash after the boom in the 40s. In this video, I want to explain to you why the home price growth we're seeing right now in America is very different from what we saw in the 40s, in the 70s, and is much more similar to what we saw in the mid-2000s, which means a crash is much more likely. And to really get a sense of this, let's compare the home price growth year over year in the last 90 years to income. And income is the orange line here, how much income per capita went up in America compared to how much home prices went up, the green line. And I want you to pay attention to the relationship here, because if we go back to the 1930s and 40s, we can see that we had a big spike in income from 1940 all the way to 1943. And that spike in income directly preceded the increase in home prices that occurred by about 3 to 4 years. The income went up first in the 1940s before the home prices did. And that's one of the reasons why we didn't have a housing crash after that boom in the 1940s, is because the income had gone up so much that people had the money to sustain the higher home prices. Now, let's go to the 1950s. We can see starting in about 1959, income growth surged to 6, 7, 8, 9, 10% a year. The income growth surged way above the home price growth. Way above the home price growth. And of course, starting in around 72, 73, this was then the period of big inflation in America that a lot of people are drawing comparisons to today. They say the inflation we're seeing in 2021 is like the inflation we saw in the 70s. And they say maybe, well, the housing market's going to continue to appreciate. But the thing you need to remember is that by the time we saw home prices going up 15, 16% in America in 1977, 1978, we had already like over a decade of crazy high income growth above home price growth before we saw this surge in home prices. And so that's important to understand about that housing boom we had in the 70s, was that it actually really wasn't inflation driven, it was income driven. The incomes in America had gone up so much that families had the money to be able to afford homes and pay more for homes. So we have both the 40s and the 70s. Yes, there were housing booms in terms of appreciation, but we could see very clearly those booms were caused by rapidly rising income. And this is really the key difference between the housing market and the inflationary periods in the 40s and 70s and today, is income growth. And that in America back in 04-05 we didn't have the income growth, and now in 2021, 2022 we don't have the income growth to support the increase in home prices. And you can see that very clearly. Let's start with the mid-2000s bubble. Home prices started going up above the level of income growth in 1998, and they continued all the way through 05. So the green line, home price growth, was above income growth, that's how you know it's a bubble. The incomes aren't keeping up with the home prices, and of course we had a massive crash where home prices went back down below income. However, since 2013 we've had a rebound, and now pretty much for 8 years in a row, and especially the last 2 years, home price growth has dramatically exceeded income growth in America. And so this is how you know that we're in a bubble today, is that green line, home prices, exceeding the orange line, income growth. I would encourage you guys to go back and re-watch the part of the video I just did so you could see the relationship between those lines. And it really all comes down to income. Are people making enough money to afford the down payments and the mortgage payments? If they are, there's no bubble. If people aren't making enough money, then there is a bubble. But what I'm about to show you right now is going to make this point even clearer. We're going to break the home price growth and the income growth into decade buckets so you can see just how unique, in a bad way, today's housing market is. So this chart basically takes the same data we just looked at on the line graph, but instead of looking at it year by year, we're looking at the averages over decades. So how much income per capita increased in the decade from 1931 to 1941, and so on, how much home prices increased per year on average, going down the list as well. And then what you can see here, and what I want you to pay attention to, is the difference between the two. You can see that in nearly every decade over the last 90 years, income growth has outstripped home price growth. In nearly every decade, income growth is higher than home price growth. Except for 1941 to 1951, income growth trailed home prices by about 1.9% per year. And then the last decade, 2011 to 2021, income growth trailed home price growth by 5.8% per year. We have never seen anything like this in a decade in the US housing market, where home prices have gone up so much more than income over 10 years. We've never seen that before. And this is clearly not a sustainable or stable system, because the US housing market is basically a mortgage market. 75% of homes in America are purchased with a mortgage. And these mortgages have very strict underwriting standards for the most part these days. There's some exceptions. There's some subprime loans in 2021, 2022. But for the most part, when you go to get a mortgage right now, they're going to look at your income and then compare your income to the mortgage payment and the cost of owning the home and the property tax payments. And so the fact that the incomes are just not keeping up at all with the home prices and the mortgage payments is a big problem for the housing market today in 2022, and suggests that it's potentially the biggest bubble of all time, and suggests that the more that home prices go above incomes and mortgage payments go above incomes, the bigger the crash is going to be, especially now that you consider the fact that mortgage rates are surging. And so if mortgage rates are surging very fast, that means that the relationship and the dynamic between income and the housing market is getting worse by the month, actually by the day. And so where this is going to end up, to put a bow on this for you guys, is that at some point, I think it's going to happen in 2022, the housing market's going to get to a place where people legitimately won't have the money to be able to buy homes. The pool of buyers is going to dwindle and dwindle and dwindle because they can't qualify for loans, they can't afford the down payments, they can't afford the mortgage payments, and that's when the housing market breaks, when all of a sudden the affordability just gets so bad that home prices have to come down. Now, this argument makes a lot of sense. I think a lot of you are following this so far and understand why income is so important in terms of showing if the housing market is sustainable or in a bubble. But there's two main objections to this argument that I gave that I hear all the time. The first is people say, well, inflation. They say inflation changes the game. That means that even if the housing market's expensive today, it's going to get more expensive into the future. But what the people who talk about inflation don't understand is that it's not actually inflation that causes home prices to go up. It's incomes going up that causes home prices to go up. For instance, if we go to 1971 to 1978, the big decade of inflation in America, we can see home prices went up by 13% per year over a decade, which was huge. But the reason they went up that much is because income per capita went up by 15% per year. So it's not inflation that causes home prices to go up, it's incomes that do that. And so anyone making an inflation argument in support of buying a home today and in support of home prices would need to be making the argument that the inflation is going to be crazy over the next 5 to 10 years, and that we're going to enter a wage price spiral where the wages and incomes just have to surge to double-digit growth consistently. That's the only way that that inflation argument makes any sense when talking about today's housing market. We need to see a wage price spiral and income go up 10, 15% a year for multiple years for inflation to have any weight in terms of supporting today's housing market. Now, the second thing people say is that, oh, well, maybe the housing market's transitioning to one that's going to be owned by corporations who use cash to buy homes, and thus it's not going to matter what people's incomes are anymore. The traditional American home buyer is going to get pushed out, and there's going to be big corporations who step in and support the housing market. And this all goes along with the Great Reset argument, and it's a tempting one to believe. However, everyone, it's important to remember that, again, like I said before, 75% of home sales still use a mortgage. So even if these corporate buyers are increasing their share and their presence, which they are, there's still a massive minority of home buyers, and they're only really buying in about 10 different cities right now. So their ability to impact the broader US housing market is pretty limited at this point. Moreover, another thing you need to understand is that the viability of these corporate buyers' business model depends on their ability to rent the homes out to Americans, and for Americans to be able to afford the rent. And with how much the rent is being jacked up right now by a lot of these corporate buyers, I don't think people can afford it. Again, go back to the wage growth and the income growth. The same thing holds with rent. At some point, people need to make more money to be able to afford the prices and the rents in the housing market. One other thing to consider is that corporate buyers are actually very exposed to increases in interest rates. While they actually make an offer in cash, the source of that cash for the corporate buyer is usually a credit facility with a bank. So the original source for the cash offer is from a bank, usually with an adjustable rate floating credit facility. So that's the important thing to understand. Increases in the federal funds rate, which are coming over the next couple of months, are going to actually hurt corporate buyers a lot, because the credit facilities that fund their cash transactions are going to get a lot more expensive with higher interest rates. That's going to decrease the ability of the corporate buyers to expand their portfolio and buy more homes. As always, everyone, if you enjoyed this video, please make sure to smash that like button. That's the best way to support this channel. Also, make sure to leave a comment down below. What do you think about this data? What do you think about the housing market right now? What are you seeing out there if you're a home buyer or you're a renter? Also, make sure to hit the join button below. If you're someone who wants more data on the US housing market, I have an offering for that. If you hit the join button, become a channel member, you get access to exclusive data, exclusive graphs, interactive graphs, as well as a newsletter that only comes out to channel members. The cost is $5 a month. Hit the join button below if you're interested in that. Data in this video came from two principal sources. Home price data came from the Case-Shiller Home Price Index going all the way back to the early 1900s. Meanwhile, data on income per capita and its growth in America comes from the Bureau of Economic Advisors. I'll have links to both of those sources in the description if you want to check them out for yourself.